understanding and knowledge of how to increase wealth through stock trading. For those of you who do not know about stock markets or investment in shares, we invite you to go to www.train2invest.com, www.train2invest.com, and download a free ebook called The Stock Market, The Untold Story. It will give you a comprehensive view of the financial services industry and how the general public is somewhat deceived into buying products through various agencies. This session is being broadcast to all individuals who are interested in turbocharging their RSPs, the TFSAs, and other savings. That is to obtain a return that is higher than inflation. And today we hope that you will get an idea of what are the factors that will impact the Toronto Stock Exchange during the first quarter 2022. We basically begin at looking at the background of where the TSX has been over 3 time frames, right? Namely a 3-year chart, a 1-year chart, and a 6-month chart. So what are charts? They are nothing more than a movement of the share prices in a picture form. For example, this chart you're watching now is a 3-year weekly chart beginning from January 2020 to December 2021. Looking at this chart, we see that the TSX somewhat crashed on the pandemic, but to use a correct technical term, it was a correction, a 36% correction when the pandemic hit the global world. Looking at the red arrow, we notice the decline was from 18,000 points, where my cursor is, to approximately 11,500 points. Now that's about a 36% decline. So what is that? What is a 36% decline mean to an individual? For example, if you had a $10,000 investment, it will now be worth $6,400. And these are something that causes fear among the average guy who's trying to generate some kind of return for his investments or his savings. Such a fall always creates headlines, and this is where you hear the person has lost his shirt buying shares. You know, bad news sells. But let's examine the chart a little further. From April all the way to December, the market increased by 91% to almost 22,000 points. 91%. So what is your $10,000 investment that you had that we talked about earlier? It's now worth $19,100. That means it's almost doubled in the time frame, in approximately 18 months. So if you heard about, you know, people losing their t-shirts, you very rarely hear how people are making a fortune in the stock market. All right, let's go on to the other point here. The pre-COVID level was at 18,000. So between the pre-COVID and now in December of 2021, you have a 22% increase. Now we'll deal with why that took place later on, but let's look at the 1-year chart. Okay, here's a 1-year chart of the TSX Composite as at closing on Friday, December 31st. And you see it moved upon approximately 17,500 points to almost 22,000 points, giving you 26%. So what does this mean in real life? In real life is if you invested the 10,000, another 10,000 in January of 2021, you would have got a return of approximately 26% return or return on investment towards the end of 2021. So the point here is the market is continuing to grow, and we'll deal with the reasons for it. Now we want to move into the 6-month time frame. Here you see the chart, which starts in July of 2021 all the way to December 2021. So a 6 months time frame, you'll see that approximately 7.5% continued growth until November of 2021. See, around here in November, you see it's grown up to about 7.5%. However, we notice that there's an up and down bouncing here of the index itself. And here is the bouncing really talks about, the technical term for that is volatility, market volatility. So in December, there was a great fear of the Omicron variant. And the reason being that Omicron, they don't know how bad it would be. So there is fear. And whenever there's fear in the market, they tend to sell off their shares. Obviously, the reason that I talk about now, getting back about 90, 91%, 26%, is a generalization that is given to you so that you get an understanding of the ability to profit from market volatility. So the idea here is not to be afraid of the market, but to know how you can profit from market volatility. So what is the cause and effect for market volatility? We have to ask this question. Well, the real truth is economic growth drives company profitability, which in turn drives the stock market. So we can talk about saying that the economic growth really drives the stock market. But the battle here is on the COVID level. Now, we can talk about other battles, historical, previous wars and things. We are not interested in that. We're only talking about this current position. So if COVID level rises, the stock market goes down. Why does the stock market go down? Because there's a fear there will be an economic shutdown. Okay? When a company is not allowed to do business, obviously it's not going to make profits, but it may end up with huge costs, rents and things like that, and which they have to meet, and therefore they won't be profitable. And so the perception is that they will sell off the stocks. Now, if the COVID is down, the stock market rises. Why? Because there's a belief there is pent-up demand. People want to spend the money, and they want to do things that they used to do before, and now there's an opportunity for them to buy into those things that they need. And therefore, profitability will be there for the companies, and the market rises. The question is, here when we look at this situation, we have to look at the question, which of the sectors within the TSX performed well? Obviously, the cruise ships or the airlines or the vacations would not have done well simply because people couldn't go anywhere. They couldn't travel anywhere. They were not allowed to travel for some time. And so those companies may not do well. So we need to know which sectors. So let's look at this particular chart. From this chart, we see the energy sector has done well. For 1 year, it grew by 77%. Now, can you imagine if your savings grew by 77%? That would be phenomenal. But that's not the real case, right? That doesn't happen in reality because we diversify, and so we have to look at maybe a lower expectation. So here we are looking at the energy sector up 77%, and we see the worst case scenario, which is the health sector, which declined by 24%. And here's the problem. Why did the health sector? One of the reasons we understand why the health sector declined, because under this category, they have included a whole bunch of cannabis companies. And you know how cannabis companies move. And so that's one of the reasons why it's declined. So we want to look at the energy sector. When we look at the energy sector, let's see what it has done. It has grown on a 1 year basis. It has grown from around below $100 up to $163, $64. Okay, in fact, you can see here the 52-week return has been on the low side at 89.77 and on the high side, which was on November 25th, 171. That means the index grew by that percentage. So it's about $82 increment. The energy index showed you that it grew by $82 in 1 year. Now, when you look at the energy companies that form part of the index, and we have picked Imperial Oil. The question is, why did we choose Imperial Oil? Some people will ask that question. Why not CNQ? Why not Suncor? Sure, we could have picked them all, but we picked IMO based on fundamental analysis. What does that mean? That means there are two things that we look at: company strength and sector performance. Obviously, I'm limiting it to 2 points, but let's look at why Imperial Oil is important. We look at company strength. Imperial Oil is owned almost 70% by ExxonMobil, and the market capital of ExxonMobil is about $284 billion. $284 billion, which is probably bigger than many cities within Canada, right? So it's a huge company. Imperial Oil is one of Canada's largest integrated oil companies, focusing on upstream operations, petroleum refining operations, and the marketing of petroleum products. Production averaged 398,000 barrels of equivalent, or BOE, per day in 2020. The company estimates that it holds 5.2 billion barrels of oil equivalent of proven and probable crude oil and natural gas reserves. IMO remains the largest refiner of petroleum products in Canada, operating 3 refineries with a combined processing capacity of 421 MBOE-day, which means 1,000 barrels of oil equivalent per day. So what's its market capitalization? It is 32 billion. Based today, it's worth 32 billion in the market capitalization. Now, just compare that to the amount of investment you're going to make. If you're going to make a $10,000 investment in IMO on your RSP account, just imagine how big this company is. It pays a dividend of $1.08 per year. So every year, if you own a share in IMO, it gives you $1.08. The payout ratio is 173%. Now, if you don't understand all the technological terms, don't worry about it. During the course, you will learn what it means. Now, we also have to look at the underlying sector performance. Here, the underlying commodity for IMO would be the price of crude oil, right? So if you look at this chart, which is also a one-year chart, beginning in January of 2021 to December 2021, you see the green and red bars. These are the share price of IMO, whereas the CLG22 is the price of crude oil, shown by the red line. And from this chart, you can see the shares of IMO tend to closely follow the price of crude oil. So when we are able to understand where crude oil is going, we should be able to some extent forecast the price of Imperial Oil. You understand what I'm saying? So if you know the price of crude oil, you're able to get an idea of where IMO should trade. Now, having said that, let's look at technical analysis. Now, technical analysis is another branch of learning that we will teach in our course. Mostly, we use a number of technical indicators to find the entry and exit points. But today, we just want to use one single technical indicator, and it's called the MACD, right? Don't worry about what it means. Just imagine a simple principle. Now, the blue line, the green and red lines show you the share price. We talked about it earlier. The blue and the red lines here is called a technical indicator. So what if, let's use a what if scenario. What if we bought and sold when the blue and the red lines crossed, right? In this case, it crossed here, it's a buy. So we bought it here at this price, whatever the price was. And when it crossed down, we sold here, right? We sold when it crossed here, and we bought again when it crossed here, and we sold it when it crossed down here, and then bought again down here and sold it down here, bought again down here and sold it down here. So based on just a theoretical use of this particular technical indicator, now obviously no one in their right mind will just use one technical indicator. They will use a couple of those, maybe 4 or 5, to get a better fine-tune the entry and exit points. Obviously, number 1 will be fundamental analysis, and then we will use technical analysis to buy and sell shares. So what did we do? So let's look at our results. On February the 12th, we paid $25.50 for this particular IMO stock, all right? And on March 18th, we sold it at $30.50. We made $5 or 20%, and it took us 34 days. At the same time, we bought 500 of those shares in the RSP account and 250 in the tax-free savings account. Why the difference? Usually you have less money in the tax-free savings account compared to your RSPs. So what did it cost us? It cost us $12,750 for the 500 shares in the RSP account, and another $6,775 in the tax-free savings account. So that is your capital invested. Now we made $5, so $5 times 500 shares will give me $2,500 profit on in the RSP account, and $5 times $250 will give me half of that, $1,250. So basically, in 34 days, we made $2,500 in this account and $1,250 on this account. So on April 28th, again, remember the chart that we showed you earlier, where the cross took place. We bought it at $32.50 and sold it on May for $38.50. We made $6, 18% return, 22 days. So here we bought 450 shares, 14,625, 200 shares in our tax-free savings account, costing us $6,500. The profit of $6 generated $2,700 in the RSP account and $1,200 in the tax-free savings account. On July 26, we bought it at $34.50 and sold it in August based on those technical indicators at $31.50. We lost $3, 9% in 23 days. We had bought 400 shares in July at $34 for the RSP account and $250 in the tax-free savings account, costing us $13,800 and $8,625. So we lost $1,200 on the RSP account and another $750 in the tax-free savings account. All right, on September the 2nd, we bought $33.50 and sold in October the 18th, $43. We made $950, 28% of 46 days. Here we had an investment of $16,750 and $8,375, giving us a generated profit for a gain of $4,750 and $2,375 for the TSFA. So overall return, we made 14%. Excuse me, 14%, which was phenomenal. Based on one technical indicator, naturally using few other technical indicators, the entry and exit points would be fine-tuned. Declining crude oil prices in July based on our fundamental analysis would have prevented the July 26 purchase. So have we stayed on the principle that the crude oil prices track, IMO prices track crude oil prices, we have seen that the oil prices was declining and we would not have made the July 26 purchase, right? We would not have bought this at this price, seeing that the oil prices were declining. Had we not bought this July 26 deal trade, we would have had a return of 22% on this only one stock that we have been trading for 2021. Now, here's the question: do people really make such returns? Right? To answer that, we have the evidence demands a verdict. So here's a client who says October 20th, 2021. We've kept his name private because he doesn't want to be blasted all over the internet. He made 656% in 5 years. And here's his trading account. Since I retired, a copy of my trading account. Since I retired from work in November of 27, I have been able to focus on my investments have done fairly well. I still mess up occasionally, that is fear and greed. I feel very fortunate to have done this as well as I have. None of this would have happened if I had not taken the Train to Invest course. I'm very thankful, Dave. Okay, we don't need to prove to any individual what is it that we want to show. What we have to do is to just let our clients speak on our behalf. Now, just saying, we often get sometimes that people talk about mutual funds. So we Googled average mutual fund return Canada. We Googled that. That's the term we used, okay? And I Google. And here, 29.3 million results at 0.52 seconds. This was the first one that came out. This was the first one. A 2.5% MER that is fairly average for advisors to recommend in Canada would give us a 5.5 average annual return, right? So you paid 2.5% to get 5.5. Only the vast majority of mutual funds do not achieve index-like returns, and mutual funds that are recommended by advisors have even worse results than that. Now, just think about this. You have paid this person 2.5%. He's given you a result that is worse. Often it's very negative. You would have lost money. And that's the problem with the mutual fund industry. You have to pay the fee regardless of the results that they give you. And so you want to sit down and think, you worked so hard for your money, what return are you getting? And that's the real question that needs to be answered by you and your family. Now, what caused the TSX to expand and exceed pre-COVID levels? It's a very good, important question to look at. Number one was the rapid opening of the economy. Governments quickly realized that massive unemployment was taking place as they shut the economy down. People were without work, factories were closed, companies were closed. Also, they had to open it very quickly, and they have been doing that. There was a higher vaccination rate as more and more people got the vaccines, got the boosters, and so on. And there's pent-up demand. I mean, for 2 years, people didn't go out anywhere. There was things they wanted to do, they couldn't. So there was a demand for products. All right, my cursor is demand for products and services. Of course, there were supply chain challenges, but that's a good thing. It takes a while for the factories to start up again and to find products and wait for their raw materials to come in and so on and so forth. So supply chain problems will not last forever. It will take a little while, but it will get sorted out. So what did we see? We saw increased company profits. Companies were starting to make money now. They were selling their products and their services, and so they were making money. And as you saw the companies making money, the company shares became in demand. As more and more people said, look, I like this company. I like this company. It's doing well. I want to buy some shares in it. Of course, the market and therefore the stock market started increasing. Of certain companies, for example, the airlines and maybe the holiday companies, the vacation companies, hotels, they didn't do too well. So that's why it's important to recognize which sectors are performing. And you don't just pick a name and try and buy those shares. That's not being smart. Now, the rapid opening of the company, the expansionary rapid reopen, supported by an excess of 16 trillion US dollars in fiscal and monetary policies globally. So 16 trillion $16 trillion were poured into the global economy, and Canada itself unveils the largest economic relief package since World War II, and this was in December 2020. Canada's federal government will spend 100 billion Canadian dollars to kickstart the country's post-pandemic economy. It is the largest economic relief package for countries since World War II, Finance Minister Freeland said on Monday. So here is where money is being poured into the economy. And, people were given money for, even though they were not working, companies were given money to subsidize their rents and so on and so forth. So really, there's a lot of money coming into the market. When we look at economic stimulus, we look at the top 20 spending packages. We don't care about Malta and Luxembourg, they're small, but look at Japan. Japan took almost above 20% of its GDP. United States, trillions of dollars. Look, $20 trillion, 24% of the global economy. They had almost 15% money being poured into. The Netherlands, Sweden, Austria, Germany, France. And so we recognize that globally, trillions of dollars are going to the market. And we talk about, where's Canada? Canada is 1.6 trillion. We're number 10 compared to the rest of the world. So what is the COVID challenge? Will the economy be shut down? It is highly unlikely, right? Omicron, while highly transmissible, is less dangerous as it does not damage the lungs. Now, I am not a medical doctor, neither do I understand all of these things. I'm taking information from what is published in the CDC and the World Health Organization. And it also says the third dose booster shots provides greater protection. And here's a Public Health Ontario tweet that was sent out recently, and it says, we compared COVID-19 cases with Omicron to closely match the cases with Delta and found the risk of hospitalization or death was 54% lower for Omicron. However, given its transmissibility, we expect an increase in hospitalization. So there is a challenge, although there are no deaths per se as high as Delta, but there is a challenge that people will be admitted in the hospital, and they need to figure those things out. So the overall economy will not unlikely be shut down unless we find greater challenges down the road. But 2022, what's the forecast? So what are the positives that we want to look at? COVID is on the decline due to higher vaccination rates. Despite Omicron, economic shutdown unlikely. A global stimulus package will have a positive impact on economic growth. Supply chain challenges will be resolved as factories come on stream. The combination of tight supply, low inventories, high demand leads to the expectation that the 2022 global economy will remain healthy. Now, what are the negatives? We don't know what other variants may come, right? This may cause, may is an operative word, economic shutdown, geopolitical challenges, global geopolitical challenges, China, Russia, Iran. We'll deal with them in a little while, but we also have the negatives will be inflation and possible massive tax increases. Now, obviously, all this $1 trillion that are poured out, or even the 100 billion the Canadian government has put out, we have to find some way to pay for it. And they may come through taxation, either through corporations or to individuals, or combination of both. We'll have to wait and see. Now, what are the geopolitical challenges? China and Taiwan. Massive military buildup suggests that China may invade Taiwan, who is a major technology chip maker, right? Taiwan makes major high quality chips which are used in cars and planes and all kinds of things. So what's the likelihood China will invade Taiwan? Based on our research, what we understand, most likely this will take place probably after the Winter Olympics. Why do we say after the Olympics? The same situation took place when Russia invaded Crimea or took over Crimea. It was after the Sochi Winter Olympics. So that's a precedent that we want to look at. Now, the second situation would be Russia and Ukraine. There's a massive military buildup suggests that Russia may invade Ukraine, rebuilding the Soviet empire. Mr. Putin, President Putin, wants to re-establish the Russian government or the Russian rule as a powerful global player. And so he comes from the old school of KGB agents, so he's forcing. Whether he will actually invade Ukraine, we are not very clear, because it will depend on what President Nixon, I'm sorry, President Nixon, same difference, I guess. The President of the United States, Joe Biden, what he will do to show Russia that he means business. Now, both China and Russia are looking at Joe Biden's what he did in Afghanistan is an example of what bad management they have of international policy. So it could be, but we are not sure exactly what will happen in Ukraine. Iran and Israel. Iran is obviously moving rapidly to complete its nuclear weapon, and this could meet with Israel response. Possible Saudi-Israel coalition versus Russia-China-Iran coalition in the Middle East. This is highly likely to happen because Iran is all really determined to build a nuclear bomb and become a very powerful, strong ruler in that neighborhood. Okay, so Israel is not going to allow them to do that, so it's likely to happen. North Korea and South Korea and Japan. China supports North Korea in testing missiles, threatening South Korea and Japan to keep the US forces away from Taiwan, Iran, and Ukraine. See what's happening here? China is supporting North Korea, so is Russia, creating all kinds of turmoil against Japan and South Korea. So what's going to happen is the US Army may be divided, or Air Force, I don't know. That's what the plan seems to be. So the highly likely things that will happen towards the end of 2022 will be China and Taiwan and Israel and Iran. That's what we think. Now, inflation and higher interest rates. Both of these are challenges for the average guy on the street. The massive amount of fiscal and monetary stimulus that governments and central banks injected into the global economy to provide a safety net during the COVID lockdowns left the residual impact of inflation, right? Because goods and services are limited and it's costing more to move them from here to there, inflation has come into being, right? We recorded inflation about 4%, and this is the other joke that I believe that governments play. You know, they take away the critical energy prices. They say, okay, we won't include energy prices because it's volatile. That is the foolish thing that they do. Everything involves the price of oil. Everything, every time. It must include that. And if you include that, it's 7 to 8%. The higher inflation has been a function of economics. Low interest rates, higher consumer demand, tighter supply, and more money in circulation results in higher inflation. When the Federal Reserve increases its interest rates, banks then have no choice but to increase their rates as well. When banks increase their rates, fewer people want to borrow money because it costs more to do so, while the money accrues at a higher interest. So spending drops, price drops, and inflation slows. That's in theory, right? So what is the inflation rate in Canada? 4.4%. We don't believe that. If you went to the supermarket and you look at the prices, you know it's much higher than that. The Bank of Canada will raise interest rates by the end of the third quarter next year. That's what they said. According to nearly all economists polled by Reuters, with a growing minority expecting the first rate hike as early as June 2022. Okay, this is what is happening. The question in the red at the bottom of the screen says, will the Federal Reserve or the Bank of Canada overplay their hand and raise interest rates to a point that will cause a recession? Now, let me tell you, the Federal Reserve and the Bank of Canada, they have never been right. They have never been right. You know, they have all these PhDs, doctorates, and whatever, but they don't have the ability to understand what goes down in the business world. That's my opinion, all right? Don't send me emails, not interested in that. But this is the record the Federal Reserve definitely has over the last 25 years. They haven't got it right. So we'll see what happens in the next quarter. Now, taxation. In order for you to understand what it means by taxation, let's take taxpayers making $40,000 or more in 2022 will see the federal government deduct more money. The Canada Pension Plan tax increase will cost workers and businesses an extra $330 each in 2022 for the maximum pensionable earnings. Okay, $330, 33. The employment insurance tax increase will cost each worker an extra $63 per paycheck in 2022, and the business an extra $89. The federal carbon tax will increase for the third time during the pandemic to 11 cents per liter of gasoline on April the 1st, 2022. Alcohol taxes will increase for the third time during the pandemic on April the 1st, 2022. Taxes already account for about half of the price of beer, 65% of the price of wine, and so on and so forth. The governments of Alberta, Ontario, Nova Scotia, Prince Edward Island impose a sneaky form of income taxation known as bracket creep. Bracket creep happens when governments don't move tax brackets with inflation, and inflation automatically bumps taxpayers into a higher tax bracket, even though they can't afford to buy more. Now, this is the truth about politicians. They really don't care about citizens. They're more interested in how much money they can take and make grandiose projects, a bridge to nowhere kind of foolishness. And we have to realize that's what they are there for. So will the TSX be good for investors in 2022, first quarter 2022? Now, several factors we must keep in mind as we attempt to forecast as to where equities will go in the first quarter 2022, that is between January and March 31st, 2022. What we need to look at, crude oil prices. What's the price range? Will crude oil prices go up? Companies, will they increase paying dividends? Share buyback program. Will companies reward investors by buying back the shares, increasing the price of shares in the marketplace? Gold, where will it head to? What factors may hurt consumer spending? These are the primary questions that we need to understand in order to determine where the market will do or what the market will do in the first quarter 2022. All right, let's look at WTI. That's the crude oil prices. For those who do not understand what WTI, it stands for West Texas Intermediate. That is the price of oil in North America, right? The price in Europe is called Brent. So we won't deal with that. We'll just deal with WTI. This is a one-year chart ending in January the 4th, 2022. And you see oil prices having moved up from around $50 in January, February of 2021 to almost $80. In fact, it went above 80 in November, has come down to 76 in this past few days. Crude oil prices climbed higher on Monday, the first session of the year, amid hopes that the Organization of Petroleum Exporting Countries, or called OPEC, and its allies, will stick to their plan to raise monthly crude oil production by previously decided 400,000 barrels per day. Oil's uptick was also due to reports that Libya, one of OPEC's more important oil drillers, will lose about 200,000 barrels daily in output over the next week because of a damaged pipeline. So we are seeing here oil prices being controlled by OPEC. Under Trump, the US was the largest oil producing country in the world, beating OPEC by quite a bit. But since Joe Biden came into power, he has now removed all those extra things that were creating the oil prices for the US. And so now OPEC is in control. And when OPEC is in control, they will control production expansion and decreasing oil production to maintain prices above. And we see that they're trying to keep prices above 70. Now, when we look at the oil prices and the various stocks, we looked at IMO, Suncor, and CNQ, to name a few. And here is the colored share prices. And comparing to the crude oil, which is in black, you see all the share prices tend to trade along where the oil price is. And obviously, it's not perfectly equal, but it gives you the upward and the downward trends. So Saudi King Salman called on all oil producers to stick with the alliance recommendations and output caps to ensure market stability. Now, when the King of Saudi calls various countries and say, hey, follow their line, it's pretty much guaranteed 99.9% will follow his decree. OPEC's new Secretary General said today that one of the group's main priorities is to promote the continuation of the OPEC Plus Pact through 2023. He was referring to production controls between the Saudis and the Russians that largely put a floor beneath crude oil price in 2026. So they are trying to maintain that level, and we will see that ongoing, and that may help Canada in its oil selling. Now let's look at gold prices. Gold prices moved between anything between 1,700 to 1,900. It's sitting around 1,800. Gold futures settled at a near two-week low on Monday as the dollar climbed higher against major currencies and global equities moved with optimism about growth outweighing concerns about the surge of the coronavirus. Higher bond yields and firmer dollar weighed on gold's appeals amid bets that Omicron variant of coronavirus won't inflict much damage on the global economy. Now, previously, gold used to be a defense in the sense that people, when they were afraid of what's happening in the global economy or in the economy, would buy gold as a protection. Now, that's a silly thing to do. If you had physical gold, you are likely to be robbed. Anyway, leaving that aside, now there's been a shift. I mean, people are still continuing to depend on the stable currency. The US dollar seems to be one of the, and also entrenching into gold prices is cryptocurrency. And we'll deal with that in a different session. Now, when we talk about dividends and share buybacks, now let's look at some of the banks. I mean, throughout the last year, we have been telling our clients the banks are the best buy because they were going to appreciate on the share price as well as increase dividends. And you see here, the dividend increase for Bank of Montreal was 25%. They bought 3.5% of their shares back, costing them about $3 billion. We have National Bank, 23%, Toronto Dominion increasing dividends by 13%, Bank of Nova 11%, Royal Bank 11%, and CIBC 10%. And here we have, for every share that you own of Royal Bank, you will get $4.80 in dividends at the end of 1 year. TD pays you $3.50. CM or CIBC pays you $6.44. BNS pays you $4. BMO pays you $5.32. And National Bank pays you $3.48. So many of our clients who had previously followed our advice are sitting on a lot of profits from banks. Now let's look at Royal Bank. Okay, let's say in January you bought Royal Banks at $100, $105, $100, whatever, right? You bought it there and you didn't do anything. You just held it in your RSP account, right? Now on January 29, the stock was trading at 103. Okay, let's say you bought it at 105. Okay, to be reasonable. So you picked up dividends, $1.80 in sometime around February, and then another one, $1.08 in April, May, June. I'm sorry, in May, the end of April, and then you had another $1.80 in August, another $1.80 in November. So you had $4.32 in dividend, and you gained $68 when the stock hit 135. I'm just using average figures here because on December 29th it did reach $135. So let's say you bought it at 105 and sold it at 135, and okay, 103. You made $68. You added the dividends. You had a return of $72.32, which means you made a return of 70%, right? This is in theory, okay? Often we make more than that simply because we will use technical indicators to buy here and sell there, maybe buy here, sell there, buy here and sell there. And that's how we get a better return than the $72 they said. Okay, now in your tax-free savings account, if you had kept it there and you just left it there, you would have had a tremendous return on your investment in Royal Bank. Now, let's talk about consumer spending. Consumer spending, inflation is a hidden tax on consumers. Tax increases reduces consumer spending. Interest rate hikes reduces consumer spending because they can't borrow and creates a higher mortgage rates. Okay, so they are slammed on those areas. Now, the overall impact, if you have strong inflation, higher tax interest and taxes, and higher interest rates, then you're going to have a decrease in economic growth. And here, governments have to be very, very careful in balancing all of these things, and hopefully they will get it right. So what is market volatility? Why is market volatility important? All right, here's a one-year chart that we put together, and we compared it to a number of stock exchanges. The TSX, which is in black, the S&P 500 in the US is in blue, the New York Stock Exchange, which is New York, is in yellow, and the Dow, which is the US 2, is in purple, and the Nasdaq, which is primarily technical, big tech companies is in green. And you see the blue arrow says actual or perceived good news. Whether there's actual or perceived good news, the market moves off. Actual or perceived bad news, the market comes down. And you see up, down, up, down. This is called market volatility. Why does this take place? Because human beings are different. Every share bought and sold, behind that is a human being. Okay, so human beings react differently, and we can get into that, into the human psychology later on in a different session. But this is where we make our profits in market volatility. Now let's look at the knee-jerk reaction. Okay, on December the 3rd, the TSX posted biggest weekly drop since January on Omicron uncertainty. Canada's stock market fell on Friday as concerned that Omicron virus variant will clip global economic activity, encouraging domestic jobs data, the index adding to this week's decline, Wall Street and so on. So the general perception was Omicron was going to be like Delta or the COVID. The markets are, everything is going to be shut down. We're going through chaos. Fine. That's wonderful. We saw it drop. And then we said, no, Omicron is not as bad as whatever. So it started moving on. So we bought Royal Bank on December 7th at 130. Remember, December 3rd was the big drop. We see the turn up now. On January the 5th, we sold it at 137. We made $7 or 5% over 29 days. BNS, we bought based on technical indicators, bought on December 9th, 85.25, sold it on January the 5th, 91, $6, 7%, 27. BAM, December 9, 73, sold it on December 29, 77, $4, 5%, 20 days. Loblaws L, December the 8th, 97, December 29th, 105, $8, 8%, 21 days. CIBC or CM 13th, sold it on the January 5th at 9.50, 7%, $23. So we had 500 shares. If you had 500 shares of these at $34 profit, the total profit for all those trades, you would have made $17,250 in 24 days, right? Now, these figures are not any particular individual. It was a combination of a number of our clients who sent us information as we look at those and we see what they've done. Okay, there are a certain group of people, not all our client base, just a certain group that we constantly receive information as to how they have done. And here's a testimony on December 17th. Good morning, Train to Invest. I would like to give you a 2021 thank you for your training and advice. I bought IFC on December 14th at 159.25. I put in a sell straight away at 163.30 based on my chart evaluation and where I would be happy. It sold this morning, December 17th at 164.84, 3% in 3 days. Merry Christmas to me. Wishing you all a very Merry Christmas and best in 2022. P.S. This puts us 17.2% so far, not counting dividends. This is a testimony just a few days ago. So in conclusion, the strong initial recovery phase that transpired following the depths of the pandemic have already given way to a more normal yet above average growth phase. This will become more entrenched in 2022. Industries most constrained by COVID-19 headwinds should continue to normalize if Omicron or some other variant does not result in disruptive lockdowns. An elevated level of infrastructure spending by governments led by the US should keep fiscal policy relatively accommodative. While China's ongoing regulatory reform agenda poses risks, we think that Chinese authorities will fine-tune fiscal and monetary policies as needed to support growth. Inflationary pressures which have spread to all regions, will be one of the key challenges facing major central banks. Right. One major concern that we have listed was China, Taiwan, Israel, Iran, Russia, Ukraine. This wouldn't happen in the first quarter 2020. All right. So we are only looking at the first quarter 2020. Get ready. It's going to be a great first quarter 2020. The next phase, selecting sectors and target companies. Unfortunately, this is only available to clients, and we'll send links for the real-time market analysis down the road. So thank you very much for listening to us. Hopefully you have the opportunity to go to www.train2invest.com to look at what we do. Follow us on this Facebook at facebook.com/train2invest, or leave us a voicemail at 204-414-9106 so that we can talk to you about your needs and our abilities to help you, or send us an email and we'll take it from there. Thank you very much.